Thanks, Matt, and thanks everyone for your time today. Firetrail is actually sort of the new person on the block, or the new kid on the block at Pinnacle, and as a result, we get the graveyard slot. So I'm not too unhappy about that, because hopefully I can leave you with a lasting impression of what the Firetrail business is all about. And effectively, our journey started in 2005 when we built and managed the Macquarie Australian High Conviction Fund. And when we were designing that product, we wanted to build, yes, a high alpha fund, but also a fund that outperformed irrespective of the market cycle, whether it was value or growth. In our investigations, we found the only way we could do that consistently was to open up the universe of stocks to all stocks in the market, whether they're value, growth, large cap or small cap. And our mantra back then was everything has a price, every company has a price. Fast forward to where we are today, today's presentation is exactly the same. Every company still has a price. Now we're at Firetrail, our approach is exactly the same. It is all about the price. Any company can be undervalued, and there are an enormous amount of opportunities in both the growth and value segment of the market. Everything can be priced. Now, to illustrate that, which here is the best investment? If you paid $50 million for the Harbourside Mansion, sure, it's one you want to live in, but it would almost certainly be the worst investment you've ever made. It sold a couple of years ago for around $10 million. Everything has a price. You need to know that price. And it's incredibly more important when you're investing in the share market. So what is a company worth? Well, most of the market generally value a company looking at the price to earnings ratio. And I'm sure most of you know, but the one or two people who may not, the PE is just the share price today divided by the earnings per share. Market average 1 year forward today, white line around 16 times. Stocks under that, clearly the banks and a lot of the value companies, and probably the most despised value companies might be trading at 9, 10 times. Above the white line, higher quality, high growth, and then the market darlings right up the top at around 25, 30 times PE. At Firetrail, we constantly find that the market consistently undervalues these growth and value stocks. And really what we look out for is this: when the market derates either a value or a growth company. Now, there's two reasons why they do that. It could be for a temporary reason, or it could be permanent. Temporary being cyclical, where obviously a short-term negative piece of news, but eventually that company re-rates back to its historical PE range. Or it could be permanent, where the market actually gets it right and that company should trade at a lower price to earnings ratio going forward. History is littered with companies where the market constantly overreacts to any piece of bad news and assumes the worst. And I'll talk about two today, one growth and one value company. Now, the growth company is Seek, and I'm sure we all know Seek. It's Australia's #1 job ads business here. It's also a dominant player in China, Southeast Asia, and most of Brazil as well. It really is that Harbourside Mansion we were talking about before. But in 2012, something happened. LinkedIn came to town. So LinkedIn is really effectively the Facebook for professionals. It was massive and it was going global, and it was very aggressive in going global. The whole market at that point, the Australian market, thought, well, how is Seek going to survive now this global tech giant is coming to town? Surely its earnings will be significantly impacted. And the market reacted. It was trading at a market darling level at around 26 times in 2010, and it derated to an actual discount to the market, trading at around $8 a share. That was exactly the profile we were looking for, that derating. We had to uncover with our research whether it was permanent, structural, or whether it was cyclical. So we did a 4-month research program, and we uncovered a few issues, a lot of positives, and 2 of those positives shaped our view. The first one is, at the end of the day, Seek had a 90% market share of the online job ads business. 90%. So when you think about it, companies that have that dominant market share of 80% or more, it's almost impossible for a newcomer to sort of topple them from that top spot. Particularly if the incumbent, which is Seek in this circumstance, was investing or continuously investing in their product range. And back in 2012, that's exactly what Seek was doing. It was working with its clients and building tailored products. And one of those products was a premium database called Talent Search. It was a good revenue earner for SEEK, but it was also a winner for their customer base. The second thing we did is we went and interviewed a lot of the SEEK's customers, the heads of recruitment for the banks, the insurers, and the other industrial companies. And they were fairly consistent in their commentary. They did love LinkedIn, but at the end of the day, when you wanted results, SEEK was the only game in town. Because when you think about it, people who register on SEEK are active job seekers. They're looking, they're motivated to move and move quickly. Everybody here, I'm sure, or almost everybody here is on LinkedIn. Quite often people are passive lookers for those opportunities or job opportunities out there. And the recruiter said the conversion rate of getting someone from LinkedIn to a job was incredibly low and incredibly time consuming, and we're all time poor these days. Then one final thing that we did the research on is any company that was lost to staff and needed to rehire quickly, SEEK seriously was the only game in town. So we made a high conviction position. We were absolutely convinced that that derating was cyclical and not structural. And as a result, it was really like buying that harbourside mansion for that shack type price. And we made about 113% for our clients. And once it hit back to its historical PE, we're happy to sell it and move on. Now, a value company that, in the same circumstance that we invested in a few years ago, is Metcash. Now, I'm not here to say that Metcash is the greatest company around. It actually should be trading at a discount. However, as I said before, every company can be priced, and so could Metcash. So I'm sure everyone knows what Metcash is, but it's the supplier of groceries to the IGA stores around Australia. So there's about 1,400 IGA stores around Australia. Now, if you went to an IGA store today, which I'm sure you have one in your local suburb, it probably looks something like this, which is the diamond store format, clean, crisp, and quite an attractive place and profitable for the underlying proprietor. But if you go back to 2015, a typical IGA store looked something like this, which was overcrowded, overstocked, redundant inventory, and quite often out-of-date inventory. And it really wasn't a place you wanted to spend a lot of time in. And this was the problem that Metcash has today, but it has always had, is they do not control the storefront. The IGA proprietors effectively own the store, so they own and can control that storefront. And this is one of the many reasons why Metcash trades at a significant discount to its competitors, both Woolies and Coles. It might not be a great company, but it still can be valued. But in 2015, a few things went wrong for Metcash. They were obviously constantly competing with both Woolies and Coles on price and doing a reasonably good job at that. But Aldi was making some significant inroads in their really good states where they were profitable, which was WA and South Australia. It's forcing Metcash to reduce prices to keep the IGAs competitive with Aldi, and as a result, reduce margins and reduce profits. At the same time, they had a very stretched balance sheet. They had to sell a couple of outstanding assets to reduce the debt, and they also had to cut their dividend to zero. In 2015, the whole market was saying, this is the easiest sell in town, and in fact, it was the most shorted company in the Australian market in 2015. But again, what we're looking for is a derating from its historical average. It was always trading at a significant discount to the market average, around 20 or 30%, but that derating down to $1.30 attracted our interest, and we did the work on that. We did a 4-month program, and again, a research program. I won't talk about all the things because we're running out of time, but two of the things that we uncovered is they had started initiatives to improve the cost base and to at least stabilise the revenue. On the cost base, very simple things like moving away from 7 state-based head offices, which is crazy when you think about it, to one national, reducing the costs and improving the communication. But the big thing they did was a massive product rationalisation program. And to give you an idea, Aldi has around 2,000 SKUs or stock keeping units, or another way to say sort of product range. You look at the larger footprints like a Woolies and a Coles, they have around 20,000 SKUs on offer. Metcash is supplying to IGAs tiny little footprints in local suburbs. They had 35,000 SKUs on offer. There's too much range. It was just crazy. So they had a massive product rationalisation program, reducing the inventory, reducing redundant inventory, and as a result of that, they actually got much better buying terms with their suppliers. After all that research, we said it is still challenged. Metcash is still a challenged business, but every company has a price. And the price on offer in 2015 was way too low in our view at $1.30. So again, we invested and made about 138% for our investor base. Very happy to sell it when it went back to its historical average, which was around 12, 13 times PE. So I've talked about a couple of stocks, but when you think about it, the biggest factor in your client's return year in, year out is generally the style, whether it's value or growth. And we've pulled together some data here, and you look at calendar year 15, this is looking at all the growth managers versus the value managers. Growth managers as a group, post fees, had a total return of just under 10%, where the value managers really didn't get much better than the cash rate. So clearly, you did not want to be a value manager, or probably did not want to invest in a value manager that year. But fast forward 1 year, exactly the opposite has happened. Value managers up 14% after fees, growth managers up around 4 or 5%. And we've seen a few presentations today, and there's no surprises which managers are doing well this year. Obviously, the growth managers are having a very, very strong year. The point here is that it's almost impossible to predict these massive moves from value to growth, back to value again. And style does have a material impact on you and your clients' returns. And in fact, the 13 years we've been running the High Conviction Fund as a team, there's actually been 6 market cycles. 3 value and 3 growth. We have the 3 growth up there, and all these components are saying is when growth stocks have outperformed value stocks. The time frame and the size is actually quite large over time. And if you look at right down the bottom, as I mentioned before, value stocks are having an incredibly tough time. Growth stocks have actually outperformed this year alone, this calendar year alone, by over 12%. So value managers would clearly be struggling at this point. But value managers have also had their time in the sun as well. There's been 3 quite long periods of significant performance via value stocks, particularly that one in the middle. So you cast your mind back to the GFC, you've finally got through everything, you're starting to outperform, and Feb 09, just as the market started to take off, value stocks outperformed, and they outperformed for about 4 or 5 years. And a lot of the second-tier growth managers in that era actually closed up because it was just too hard, too many years of constant underperformance. And what we built 13 years ago was to build an all-weather, high alpha fund that was, impervious to these value growth cycles. The table on the side shows the excess return the high conviction funds have delivered year in, year out, irrespective of whether it's value or growth. So outperformance independent of those market cycles. So thanks very much for your time today. I mean, at Firetrail, it is all about the price. Any company can be undervalued because the market constantly overreacts to news. And finally, there are enormous opportunities year in, year out in both growth and value companies. Every company has a price. So thanks for your time, and I'll hand back to Matt Dell. Thank you.